Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Thursday. It's December 29th. Tomorrow's December 30th, and the party starts. The end of the year is here, and it's been a miserable, nasty, unpredictable year with a bunch of false starts and just a lot of confusion throughout the world. And as I'll talk about more of that as I get into the analysis. But it's about 8:22. We are going to have the jobless claims numbers come out in probably about 8 minutes or so. I'm not really worried too much about it. The number has been really, really solid. I would say this year, out of all the major reports we've seen, and I really do mean that, the most stable report has been the jobless claims report. It's been right around the 200, 250,000, between 200, 250, right around the 221. So anything around the 4-week moving average, and don't nitpick. You know who you are. All you engineers out there. I live with engineers, so I know how it is. I know exactly how it is. They're very detailed, and I like that. But don't get nitpicky about this, because anything around 200 to 230, 240, it's not going to have a big impact on the market. There is something squirrely going on today, and I want to talk to you guys about it. And the Dow is up about 96 points. I forgot to mention, we do have some upside on the NASDAQ today. And the big question right now in everybody's mind is, has the tech stocks bottomed out, or is there more to go? Because I see a lot of people asking me, Roger, is it time to start buying tech? Is it time to start getting into technology stocks? Well, let me answer your question via my analysis. So first thing is really weird. Now, remember yesterday and the day before, China was saying how COVID is declining, things are getting better. Just yesterday, I mean, unless I'm crazy, please tell me I'm crazy. But wasn't I just reading yesterday in the report how things are getting better, how they're going to open things back up? All of a sudden, the next day, things aren't looking all that great. So it's really frustrating to get good information, because China is the second biggest economy in the world. But as I read this, you got to ask yourself, Roger, are things getting better in China, or are things getting worse? Like, what the heck is going on here? So growing fears about a recession in 2023 and a surge in COVID cases in China weighed on sentiment yesterday. I mean, just yesterday morning, pre-open, I was saying how things are opening back up. It's nuts. I had to get that out. Wednesday's trading session, the NASDAQ slid to more than a 2-month low as the U.S. Treasury yield, which we look at every morning, and I warned you was going to have a lot of pressure on tech, recovered from a brief fall to rise for a third consecutive session. Bonds aren't doing great. I'll show you in a few minutes. Apple is leading the decline in large cap tech stocks. A few days ago, it was Tesla. Keep in mind, Apple and Tesla have a lot of market cap. Now, here's the interesting part. Energy stocks also retreated, dragged by lower oil prices as surging COVID cases in China, the world's top oil importer, weighed on sentiment. I give up. Just the other day, they're telling us things are getting better. Literally, the other day, yesterday, I think. Data on Wednesday showed that, I do this every day, so days run into each other for me. But I think yesterday, if I look at my video, there was a note about how China is opening back up because things are getting better. And today, they got surging COVID. I don't get it. Oh, boy. Data on Wednesday showed that U.S. pending home sales stood at negative 4% month over month, weaker than expectation of 0.8%. Now, this is important. Why? Because it's falling for the 6th consecutive month in November to the second lowest on record amid rise in borrowing costs. That's not a surprise. If anybody thinks that home prices are not going to be slowed down, I got a bridge to sell you. Now, here's an interesting part that I haven't seen in the last few days. So there's a 71.9% that the Fed is going to raise rates 0.25, and a 28% chance that the Fed is going to raise rates 0.50. I think that's fairly baked into the market unless we see something drastic next month. And with this economy, we may see something drastic this month, but it looks like what's baked into the market as of right now is a solid over 70% chance of a 0.25, and we're going to go with that. If they all of a sudden go to 0.50, that's going to really, really change the sentiment. Today, all eyes are on the U.S. jobless claims, as I talked about a minute ago. They're looking at the number to stand at about 225,000 compared to 216,000. I'm not going to make anything of it, and if news reports do, they're just trying to throw you off, because the number has been really solid. I really need to see the number go like 300,000, 350,000, or 150,000. I want to see it off of that 200 number, which has been there for all year long. Crude oil inventories will be reported today as well. Economists estimate the figure to be at negative 1.52 million compared to 5.894 million. Let's see how it impacts the energy market, which has been kind of nasty. And that's disappointing because we have a lot of exposure in the energy sector. Eurex is up slightly. However, those gains are likely to be fragile as worries about the spread of COVID-19 from China weights on appetite or risk appetite in one of the final trading days of the year. Risk appetite faded on news that several countries would require inbound airline passengers from China to show a negative COVID-19 before entry, including the country we live in right here, the USA. China Shanghai closed lower as rising COVID cases in China worried investors and raised doubts that the chance of a quick recovery, that's what I was talking about, from the world's second largest economy after the relaxation of severe COVID restrictions is actually going to happen. On Monday, Chinese National Health Commission announced it would stop requiring quarantine for inbound travelers starting January 8th. However, and this is a big however, several countries, including United States and Japan, imposed mandatory COVID tests for travelers from China. The Nikkei index closed at a 3-month low. Now, as far as movements today, expect a move from Tesla pre-open. It's up about 3% before the opening hours, and Cal-Maine Foods, which is down 3%. As I explained yesterday, they were reporting earnings. That stock is down. There are no major earnings for today. There are no major earnings. And yes, I'm expecting more corrective pressure on this crazy, crazy market. Now, if you look at the bond market, and we've been looking at the bond market, and I warned you that this route right here is going to put a lot of pressure on technology and consumer discretionary and all those stocks that are impacted by interest rates, basically the stocks that rallied hard during COVID, if you will. And I think we still have more downside to go. Now, we're holding on by a thread, and we are below 100 now, and I genuinely think that the bond market is going to go down further. Now, what is that going to do to the stock market? Well, you could probably see communication, consumer discretionary, technology, and real estate. Remember, real estate is also very much impacted by higher rates. And when bonds go down, rates go up. Remember, there's an inverse relationship between bonds and interest rates. So this going down is putting more pressure on bonds. And hopefully you could see now why I was so hesitant to take any long trades since January in the bond market. And I am going to continue trading the bond market to the downside after we get a pullback from the down route we're going right now. And again, I wouldn't be surprised if we went a little bit lower, maybe to the 95-ish level, but this has more downside in my opinion. And again, we're going with the trend. Now, looking at the major indices, healthcare, industrial, consumer staples, energy, you want to stay long these four. And you want to go short technology, real estate, communication services, and consumer discretionary. Real estate is in the same ballpark as tech because of higher rates right now. Now, I want to show you guys something interesting. Now, look at the number of breakouts to the upside, 17, okay? Look at the number of breakdowns to the downside. Upside, 17 stocks are making 20-day highs, and 368. You know what? Let me change the price here. Price to 2,000. There we get like a lot of expensive stocks too. Let's just save this. Let's save this. There we go. Save. All right. Now let's fetch. Let's go back here. I just changed the price, so it works with higher prices. So let me just see what the number is now. So 20-day breakdowns, 393, didn't really change much, versus 17. Now this number, 393, that's a pretty big number. Whenever you see, like yesterday, let me show you yesterday, 64 versus, look, 200. And before that, 88 versus 64. It was even. Now, if you look at it today, you will see that there's 17 there, and there's 393. Now, last time the market bottomed out, this number went to about 500, 600, 550, 600. I think there's more downside to go. I'm not seeing a lot of strength right now before New Year's, and with this China issue with restrictions in the air, in travel, that's a big red flag. And also, again, there's only 17 stocks making 20-day breakouts, and 393 making 20-day breakdowns. Now, if you look at the QQQ, which we will right now, the question is on everybody's mind is, has it bottomed out yet, or does it have more to go? Well, I think we're very close. And I think we're going to go counter to the trend in the next couple of days. But I think we need to see a little shakeout. So don't be surprised if the next day or two we went just a little bit lower before heading higher. What I'm encouraged by is the fact that the NASDAQ right now is starting to enter a trend, a choppy period. It doesn't look like it's going as much up and down. It looks like it's consolidating. And the fact that it's consolidating right here makes it look a lot more like the ARK fund. Notice the ARK fund is just consolidating. Now, it did break lower. Let me just adjust this a little bit. It did go a little lower, but look how choppy it's been since May of last year. And these are the most interest rate sensitive stocks. These are the high flying stocks that went from 161 to 30, okay? So most of the downside is done. And the question now is the NASDAQ done? Is the NASDAQ finished? Is this going to be a chop, or are we going to go lower? Well, I actually think we're going to go a little bit lower, but not much lower. Just a little bit lower, shake out the weak hands, and we're going to start coming up. Remember what I said. I don't think the market is going to go all that much lower. Now, I do think the S&P 500, it's got more downside. You see this right here? I think it's going to crack this open and come down. But the QQQ, I think most of the QQQ is already there. Keep in mind, look at the Dow Jones. The S&P is like a halfway point between the Dow and the NASDAQ. Look at how strong the Dow is compared to the S&P, right? The Dow is above the 200-day moving average. The S&P is below the 200-day moving average, and the QQQ is all the way down. So to me, it looks like most of the pricing pressure is priced in on the downside on the tech stuff, but isn't priced in on the blue chip stocks. Now, that's not good for energies and all those other stocks, but we got to stay firm because we believe, and not only do we believe, we're seeing strength in those sectors. But what I'm saying here is I believe that the NASDAQ has a little bit more downside and may start getting choppy. And that means it may be time to start looking and nibbling a little bit on stocks like Apple, Nvidia, and stocks that are all the way low, because I think the downside here is limited. And I'm really encouraged by the choppiness that we're seeing here, because it's not a downside strobe like this. But on the overall market, which has a very broad exposure, I still believe we're going to break through this level right here. Looks like a head and shoulders almost right here, right? Shoulder, head. I'm being a little facetious, but you see what I'm saying. So I think if we can break this level right here, we can go all the way down, because there's a lot of non-tech stocks here, and they still have some downside to go. For example, real estate, communication services. But as far as consumer discretionary, and maybe even communications, which is mostly the FANG stocks, see how they're in a very choppy period. So and they were in a choppy period here and here. So I think that the fact that it's so choppy is telling us that the rout is already behind us, and most of it is assimilated. So I do think the downside is limited in the tech stocks right now, but I wouldn't be holding my breath for a major move. Let's see how the futures are looking right now. The report should have already come out, and it looks about flat. Let's see if we can get some idea of how the numbers are looking here. Remember, this is the last jobless claims report, and I'll let it roll while we're looking at ETFs. Now, remember, it's Thursday today, and Thursday, I always give you my top ETF. Well, my top ETFs have been healthcare, industrial, consumer staples. I'm actually right now really, really focused on consumer staples. Let me show you. And I've been telling you that all year, by the way. I love consumer staples. If you look at consumer staples, they look like they're very choppy right now, and they're kind of consolidating. I think they're going to start going higher. I don't think there's a lot of downside left. I also like XLI, which is the industrial sector. And again, it's doing the same thing. And I like the energy sector. So the question is, which of these sectors do I like the most? Well, I'll be honest with you. I'm liking energies the most here, but I want to be a little more safer, so I'm going to pick healthcare. Healthcare, healthcare, healthcare. It's been my strongest sector all year, and I'm going to remain with it. So my suggestion is on healthcare. Let me give you an option. I would go to 51 days from now. Actually, I would go further. I would go 78 days from now. And let's see, we're 135 right here, or 136. Don't buy it now at the open. If you wait towards the closing bell, you're going to have a lot more liquidity. Or you can buy the February one, which already has more liquidity, near the 134, 135 area. Just wait for it to open. The spreads will tighten. And then you can roll it over after about 20, 25 days if you don't have profit. I wouldn't recommend holding for more than 30 days. So that's what I've got for you today. Before I let you go, I've got something really important. Now, my newest strategy might be the best one yet. It doesn't use fundamental analysis or technical indicators. Instead, it focuses on spotting a few very specific patterns. It's a completely different way of finding entries and exits than you're likely used to. One of these patterns, for example, boasts a 100% win rate on exactly 146 stocks, 146 stocks over 5 years of testing. And it's based on historic testing, and I wouldn't expect that kind of win rate forever. But I'm incredibly excited on stocks not listed on that index. You guys got to check this out. And you can see exactly what I mean by clicking the link below. The training session below could be a game changer for you. Folks, New Year's is upon us. Discover a new way to trade. Discover a way to take advantage from the market in a way you've never seen before. Follow the link below, and I'll see you soon. Happy upcoming New Year's. Bye, guys.